First off, there's no advice, no tax advice, no legal advice, no financial advice. This presentation is intended solely for educational purposes. And secondly, the purpose of life insurance is for the death benefit protection. Any other benefit is purely ancillary.
Recording. All right, this is Tom Rutkowski with Innovative Retirement Strategies. I'm sitting down with a potential client and we're walking through my life insurance retirement plan to traditional IRA comparison tool. So basically what we're looking at here is a comparison of two people. One has a traditional IRA with $1 million in it. This is, you're assuming that the person is at retirement age. And the other person has $1 million of cash value in a life insurance retirement plan. That could be an IUL or a whole life, either one. And for the purposes of this example, I'm assuming that the cash value is earning a rate of 10% growth year over year. It could be in mutual funds, it could be in anything. But we know that achieving a 10% year over year growth is pretty unlikely in the real world. I'm assuming that the cash value in the life insurance policy is earning 6%, and that for the purposes of taking a policy loan, you can borrow against the policy at 5%. Both people, one with the IRA and one with the life insurance retirement plan, need $80,000 of net after-tax income after in retirement. And the person with the IRA is subject to 35% tax rate. And we know that a life insurance retirement plan is tax-free income because the money's coming to you via policy loan. And the other thing is, I need to take that out. So I've got an inflation rate of calculation in there, but I've got it set to 0 now. So disregard the note where it actually says we're adjusting it every 2 years for inflation. I've got that out right now. So let's start with the traditional IRA first. If the person needs $80,000 of net income, and I'm talking to my mouse right now, so I've got the first row of the spreadsheet highlighted. If the person needs $80,000 of net after-tax income, they need, since income or withdrawals from an IRA are not taxed yet, you need to take out $123,000 to pay the tax of $43,000 to still net $80,000 after tax. And I don't think it takes a rocket scientist to figure out that even if your money's growing at 10% per year, you can't take $123,000 a year out of that IRA and expect it to last very long. So in this example, that person is going to basically run out of money around the 14th year of the policy of the retirement age. Retirement. On the other side, we're looking at somebody with a life insurance retirement plan. So here, to get income from a life insurance retirement plan, you're basically borrowing against the policy's cash value. So all 50 states have language in their insurance statutes that basically require that insurance companies must make loans to their policy owners secured by the cash value of those policies. So it's really a no questions asked. You literally call up the insurance company, they verify that you have the money, they set up the plan, and they start sending you checks every month or every year, however you want to get it. So my common rule of thumb is in a life insurance retirement plan, you can take about 8% safely and never run out of collateral for the rest of your life. And this example kind of shows that. So the person is starting off with $1 million of cash value. And they take a loan for $80,000. Basically, at that point, they've got $920,000 of remaining cash value collateral that they could borrow against. So hopefully that's clear. If the policy is growing at 6%, the policy earns $60,000 during that first year. So now, if you look down, look across actually, highlight that row. $60,000 is the return on the cash value, assuming that we 6% growth. So we finished up the year with $1,060,000 of cash value at 5% on 80,000, we owe $4,000 in interest. So you're literally borrowing another 4,000 from the insurance company to basically pay them the interest on the loan that you're taking. So you're not paying the interest from out of pocket, you're literally borrowing the interest from the insurance company. So you're going to finish up the year with an $84,000 loan balance. You took 80 of that as income. And after the $60,000 was credited, you're basically finishing the year with $976,000 of collateral that you could still borrow against. So is that clear? Okay. So to get that $80,000, one thing I want you to notice is that you really only tapped into your collateral by $24,000. When all is said and done, you finished up the year $24,000 down from the original $1 million that you had, even though you got $80,000 of income. Whereas in the IRA scenario, when you took $123,000 out, it may have grown by 10% that year, but you still went down quite a bit in terms of cash. So I'm not going to go through each row of this because you kind of get the idea that each year you're borrowing against the policy, each year you're financing the interest. But if you understand the rule of 72, the rule of 72 is if you take the interest rate that you're earning on your money and you divide that into 72, that's how long it takes to double your money. So at 6%, 6 into 72 is 12. So every 12 years, we can expect the cash value to double. And if we look down to year 12 here, I'm going to highlight that row. You can see that the cash value is kind of rolling over from 1.898 to $2 million that year. And what's interesting here is if the policy is earning 6%, like what I stated, now the return on $2 million at 6% is $120,000. So to get that $80,000 of income, we're really only borrowing against the gains on the policy now. Whereas earlier we had to tap into the collateral of the policy in order to get that money. Now that 80,000 is literally coming out of the gains. Now we've got all the finance interest. So you can see that over time the collateral is going down. And we basically design the life insurance retirement plan such that we're tapping into that collateral as low as we feel comfortable. And then all of a sudden the compounding interest starts to take over. So right around this point, right in here is about the minimum point before all of a sudden that 1% arbitrage, the difference between the rate that you're earning, 6%, and the rate that you're paying, 5%, all of a sudden we start going up the other way. So you could see here that we could actually take something much greater than 80,000 and still not risk the cash value collateral of the policy. I mean, we could take this we could increase the loan amount such that the collateral dips down as close to zero as you feel comfortable. But in the real world, we have cost of insurance to deal with, which on most IRA, most index universal life is around 1/4% once you're out this far into the future. So it's really not a huge load, but it is something that you need to be cognizant of, that it does tap into your overall return. But at this point, do you have any questions? I mean, did this do a good job of covering it?
Well, I mean, I have some questions. It's may not be specific to what you just went over.
I could edit that. So at this point, I can end the video. But go ahead. These might be questions that people want to know.
Yeah. So I've heard of some insurance companies so say you're paying a 5% interest on whatever loan you take. Do you get okay, so let me back up. Like when you take money you borrow against your 401k, and the interest that you're paying, you're actually paying yourself back the interest.
Right.
Is there something that is kind of related the same way as a 401k when you pay back the interest? Or is it all just being charged?
So the fundamental difference between a 401k, borrowing on a 401k and borrowing on life insurance is a 401k loan is you're actually withdrawing your money from it. So now it's no longer invested in the things that you had it in. So like if you had it in an S&P index fund, for example, now when you take that money out as a loan, it's no longer there earning anything. So when you pay yourself interest back, you're really, unless you pay yourself 10%, you're not even putting back where the money would have been had you just left it there.
Gotcha, that makes
So
sense.
the life insurance retirement plan, you're borrowing against the policy's cash value. So you're getting a loan of the insurance company's money with your cash value as collateral. So your cash value continues to earn interest just like it would have, had you not taken the loan. So you do owe interest on the loan to the insurance company, and you have to pay that, but it has no impact on your policy.
But what did
So
you
like,
say before that interest that you're paying is actually a part of your loan?
So I think I see where you're going here. If you're familiar with the infinite banking concept, a lot of times I think it's a little deceiving because they get people to think that they're borrowing from their own bank and paying themselves back with interest and growing their cash value by paying themselves interest. And that's just fundamentally not how life insurance policy loans work. So if they were to set it up for you paying yourself back 10% interest, really 4 or 5% of that interest is being paid to the insurance company. And then the remainder of that 10% is actually being used to buy more paid up additions in the life insurance policy.
Mm-hmm.
And that's not the same because there's nothing stopping you from setting up a policy that's got the paid up additions maxed out right up front. So you could have had more money to borrow against had you just put it in at the beginning instead of paying yourself interest, quote unquote, as you go along.
Mm-hmm.
It's not mathematically efficient to do it that way. If you're doing the double play, you want as much of your dollar that you're putting into the policy working in two places at one time as possible. You don't want to be able to put it in later. Does that make sense?
Yes.